So equity compensation, right. It always sounds like this ultimate corporate dream, you know. A company gives its employees some stock, the company grows, the stock price skyrockets, and suddenly everyone is like putting a down payment on a house.
Right. Yeah. It feels like this beautiful, simple alignment of incentives.
Exactly. But I feel like the moment you actually peek under the hood of how a company administers that stock, you realize it is, well, it's less of a dream and more of a highly volatile, heavily monitored regulatory obstacle course.
Oh, absolutely. I mean, giving someone a share of stock is actually a massive legal event.
Really, it's just handing over a share.
Yeah. The second that equity changes hands, you trigger this huge cascade of tax codes, Securities and Exchange Commission mandates, accounting rules. I mean, it can quite literally bankrupt an employee or even derail an entire corporate acquisition if it's handled incorrectly.
Which is exactly why you are here with us today. So welcome everyone to this special exam prep deep dive. And if you're listening to this, you are the learner. You're gearing up for a massive high-stakes test on the mechanics of equity compensation.
And you need to understand not just what the rules are, but, why they exist and how they trap unsuspecting companies.
Right. So our mission today is to trace the chronological life cycle of a company's equity. We're going to start with the intense microscopic preparation required to take a private company public.
Yeah, the pre-IPO phase.
Yeah.
And then from there, we'll navigate the relentless disclosure requirements of daily life as a publicly traded entity.
The new normal.
Exactly. And finally, we'll look at the ultimate corporate plot twist, right? When two companies collide in a merger and acquisition and their equity plans just have to be brutally reconciled.
It's going to be a lot, but we're going to distill the densest tax codes into concepts that actually stick in your brain. And because, you are prepping for an exam, we've woven 3 specific scenario-based knowledge checks into the discussion.
Yeah, we aren't going to treat you like a kid taking a pop quiz or anything.
No, definitely not. But we are going to pause and just lock in the exact logic you need to ace this test. So let's start at the very beginning of the life cycle. Getting the house in order for an initial public offering. Chapter 4 material.
Right. And, the transition from private to public it's a brutal awakening for corporate management.
How so?
Well, a private company has immense flexibility. I mean, they can hand out options to early employees out of this loosely defined pool, basically just based on gut feeling.
Just kind of making it up as they go.
Yeah, essentially. But the SEC, they demand a rigid mathematical structure before they let you solicit money from the general public. So the very first thing a company has to do is tear down and amend its existing equity plans.
Okay, so they have to look at the total share pool and establish strict parameters, right? Like per individual share limits on how much can be granted in a single year.
Exactly. And they usually can't just keep one giant pool for everyone anymore. They start adopting entirely new plans that are specifically designed for public scrutiny.
Like an employee stock purchase plan, right? An ESPP.
Yes, an ESPP is a big one. It allows for broad-based, disciplined employee participation. But they also carve out a separate director's equity plan.
Oh, interesting. Why separate the directors from everyone else?
It's entirely about optics and fiduciary duty. Think about it. If the board of directors, the exact people responsible for approving equity grants, are pulling their own compensation from the same limited pool as the rank-and-file employees.
Oh, I see. It's like they're in charge of the cookie jar, and they're taking cookies from the same jar they're supposed to be rationing out.
That's a massive conflict of interest. Institutional investors absolutely hate that. So a separate plan establishes a clear boundary and protects the directors from accusations of self-dealing.
Makes total sense. But, restructuring the plans is just paperwork compared to the human element, because as an IPO approaches, the biggest immediate crisis is usually employee liquidity.
Oh, yeah. The human element is huge.
You've got these engineers or marketing directors who've been holding paper wealth for 5 years, and the moment the company announces an IPO, they start shopping for cars and houses.
Oh, they definitely do. But if everyone dumps their shares on the day of the IPO, the stock price crashes before the closing bell even rings.
Right. So how do they stop that?
Underwriters, the massive banks that are actually taking the company public, they will not allow a crash. They legally force insiders and employees into a lockup period.
And that's usually, 180 days post-IPO?
Typically 180 days, yeah. During that time, they are strictly prohibited from selling their shares. The market just needs time to absorb the new public float and establish a baseline valuation without this flood of internal supply suppressing the price.
Okay, so the employees just have to wait out the 180 days. But even when that dam finally breaks, Employees holding restricted securities can't just, like, liquidate their entire portfolio on day 181, right?
Well, they can't, because then they run headfirst into SEC Rule 144.
Rule 144, break that down for us.
So Rule 144 acts as a pressure valve. It's an exemption that allows the public sale of restricted stock, but the SEC places heavy chains on it to prevent sudden market shocks.
Heavy chains like what?
Well, assuming the company is current on all its public reporting, the security still must have been held for at least 6 months. And more importantly, there are aggressive volume limits.
Volume limits meaning they can only sell a little at a time.
Exactly. In any given 3-month period, an insider cannot sell more than the greater of 1% of the outstanding stock, or the average weekly trading volume.
Oh, wow. So it literally forces a slow drip instead of a fire hose.
Precisely. But, the SEC isn't just worried about what insiders do after the IPO. They're notoriously paranoid about what executives do right before the bell rings.
And that brings us to the regulatory landmines lurking in the shadows of the pre-IPO phase. Let's talk about the Rule 16a2 look-back rule.
Yeah, so Section 16 of the Exchange Act is designed to track the trading activity of corporate insiders to prevent them from profiting off secret information.
Makes sense.
But when a company goes public, its officers and directors suddenly become subject to these Section 16 reporting rules. And the look-back rule dictates that the SEC doesn't just start watching you on the day of the IPO.
They look backward.
Yeah, they retroactively pull your private history into the public light.
Wait, okay. So if I'm a director and I privately sold some of my shares to, I don't know, a venture capital firm 3 months before we even filed for the IPO, how does that become a liability? It was a private transaction.
Because if you execute a reportable public trade within 2 months after the IPO, the SEC looks backward 6 months from that new trade.
Oh, so your private pre-IPO sale is suddenly dragged into the spotlight.
Exactly. The SEC can match that pre-IPO sale with your post-IPO purchase under the short swing profit rules. If the math shows you made a profit by trading in that 6-month window, you are legally forced to disgorge those profits and return the money directly to the company.
Wow, that is a terrifying trap for an executive who thinks their private history is sealed.
It really is.
But an even bigger trap for the company itself is the concept of cheap stock. This happens when management tries to do their employees a favor by granting them stock options at a really low exercise price right before the company goes public.
Yeah, it's a classic mistake.
It's essentially like trying to buy the house next door for 1990s prices the day before you know the neighborhood is going to be rezoned for luxury condos.
I love that analogy. And the SEC views that rezoning trick as financial fraud. I mean, they actively hunt for options granted in the months leading up to an IPO at prices significantly below the anticipated public offering price.
Because they assume you're hiding something.
Exactly. Their perspective is that the company is hiding compensation. If you grant an option at $2 a share, and 3 months later the IPO price is at $20 a share, the SEC presumes you knew the stock was worth more than $2.
And the punishment isn't just a slap on the wrist, right? If the SEC determines you issued cheap stock, they force the company to retroactively record a massive compensation expense on their income statement.
For the difference between that exercise price and the offering price, yeah.
Which means you suddenly have millions of dollars of unexpected expenses hitting your bottom line right when you're trying to convince Wall Street that your company is highly profitable.
And an unexpected cheap stock charge can completely derail an IPO roadshow. It just destroys the earnings per share metrics that investors rely on to value the company.
All right, let's pause and lock this in for the exam, because this exact scenario is prime testing material. It's time for our first knowledge check. Okay, listener, if you are reading a case study on your test where a company grants stock options to employees shortly before an IPO at a price significantly lower than the public offering price, you need to identify the term for this violation and the specific financial penalty the SEC imposes. What is it?
So the term you're looking for is cheap stock. And the consequence is that the SEC will require the company to record a compensation expense on their financial statements for the difference, which severely impacts their reported earnings.
Keep that locked in your memory. So moving on to Chapter 5. Let's assume the company survives the SEC audits, the pricing goes off without a hitch, and the IPO bell finally rings. The confetti drops. But crossing that threshold into public life isn't the finish line, is it?
Not even close. It is the beginning of a relentless, never-ending regime of public disclosure. The legal status of the equity fundamentally changes overnight.
Because a public company can't just issue shares to its employees the way a private company can.
Right. Before a single share can be granted to an employee under those newly structured public plans, the company must file a Form S-8.
Form S-8, what exactly is that?
It's a highly specialized, simplified registration statement. It incorporates the company's other massive public filings by reference, which makes it faster to file, but it is an absolute legal prerequisite. If you issue shares without an active S-8, you are committing a securities violation.
Okay, so Form S-8 gets the employee plans legal, but the regulations surrounding the top executives get aggressively tighter, mostly because of the Sarbanes-Oxley Act, right? SOX.
Yeah, SOX was born out of massive corporate accounting scandals. Its primary goal was to stop executives from treating the corporate treasury like a personal piggy bank.
And one of the most stringent provisions of SOX is a blanket prohibition on personal loans from the company to any of its directors or executive officers.
Which sounds like a simple governance rule on the surface. But it creates a massive mechanical headache for a very standard equity practice known as a same-day exercise and sale.
Right, the cashless exercise. Let me break this down. An executive has options, but they don't have like millions of dollars in cash sitting in their checking account to actually buy the shares from the company.
Most don't, yeah.
So they use a broker. The broker essentially fronts the money to exercise the options, instantly sells the resulting shares on the open market, and uses the proceeds to cover the purchase price, the taxes, and their own fee, giving the executive the remaining profit.
But the mechanical problem lies in the settlement timeline. The broker is fronting cash to buy the stock before the open market sale actually settles and the cash is collected.
So there's a momentary gap.
Exactly. And if the company is actively involved in arranging that short-term credit extension with the broker, the SEC can interpret that momentary gap as the company facilitating a personal loan to the executive.
Because the company is effectively guaranteeing the transaction.
Wow. So to avoid a SOX violation, companies have to step entirely back and ensure the credit arrangement is strictly a private agreement between the executive and their personal brokerage firm, with zero corporate involvement. That structural distance is absolutely critical. But honestly, the most grueling day-to-day reality for those executives isn't exercising options, it's Section 16 reporting.
Yes, the heartbeat of public market transparency.
Any insider, meaning officers, directors, or anyone owning more than 10% of the company, must report every single change in their beneficial ownership of the stock.
And the timeline they have to do this is absolutely brutal. They have to file a Form 4 electronically with the SEC within 2 business days of the transaction.
2 business days. It's relentless.
If an executive buys or sells a share on a Monday, the entire global market has to know about it by Wednesday night. But honestly, I've always found this entire concept deeply paradoxical.
How so?
Well, think about it. If I am the CEO of a publicly traded tech company, I technically always possess material non-public information.
That's true.
I know what the unreleased quarterly earnings are. I know if the FDA is about to reject our new drug. So how can I ever legally sell my shares without violating Rule 10b-5 and committing federal insider trading?
It is the ultimate paradox of executive compensation. If the SEC rigidly enforced Rule 10b-5 without any exemptions, public company executives would literally never be able to access their wealth.
Right, they'd be trapped.
So to solve this, the SEC created an affirmative defense known as the Rule 10b-5-1 trading plan.
Okay, an affirmative defense, meaning you admit you possess the inside information at the time of the trade, but you prove that the information didn't cause the trade. How does the mechanic of that actually work?
The executive must establish a legally binding written trading plan during an open window.
An open window meaning a specific period when they do not possess any material non-public information.
Exactly. And this plan strips the executive of future discretion. It must pre-specify the exact amount of shares to be sold, the specific price limits, and the exact dates of the future sales. Or it must dictate a rigid mathematical formula that a third-party broker will execute automatically.
Okay, so it's basically an autopilot system. If I set up a plan in January when the skies are clear, instructing my broker to sell 1,000 shares on the 15th of every month, and then in June, we discover a massive accounting error. When my shares automatically sell on June 15th, the SEC can't prosecute me because I made the decision to sell 6 months ago.
The legal separation of the decision from the execution is exactly what provides the defense. And transparency around this has actually only increased. Based on recent source material updates, starting in 2023, the SEC mandated a new rule requiring a highly visible checkbox on Forms 4 and 5.
A checkbox.
Yeah, insiders must explicitly check this box to indicate to the public if a reported trade was executed pursuant to a Rule 10b5-1 plan.
Okay, that brings us to our second knowledge check.
Let's do it.
Listener, if you're staring at a multiple choice question on your exam about executive trading, here is your scenario. An executive needs to routinely sell shares to pay for their children's tuition, but they are constantly exposed to material, non-public information. What specific SEC rule provides the affirmative defense they need, and what is the exact reporting deadline they face when the trade actually happens?
The affirmative defense against insider trading is the Rule 10b5-1 trading plan. And the reporting mechanism is the Form 4, which carries a strict deadline of 2 business days following the execution of the transaction.
Got it. Now, beyond individual trading, being a public company also means the government aggressively polices how much you pay those executives.
Oh, absolutely. Enter tax code section 162 meters.
Right, where the IRS limits the ability of a public company to deduct executive compensation as a corporate business expense. The cap is a hard $1 million per covered executive.
The tax philosophy here is really about aligning pay with shareholder value. The government is essentially saying, look, you can pay your CEO $10 million if you want, but the taxpayers aren't going to subsidize it.
Only the first million is deductible. Anything above that eats directly into corporate profits.
Exactly. Furthermore, if the company pays out massive performance bonuses based on financial metrics that turn out to be fraudulent or erroneous, they run into the Dodd-Frank clawback rules.
The clawback mechanism, which forces the company to actively recover or claw back any excess incentive-based compensation from the executives if the financial statements have to be restated.
And it doesn't matter if the executive didn't personally commit the fraud. If the math that triggered their bonus was wrong, the money has to be returned.
It creates a pretty ruthless environment of accountability.
It does. And just when a company masters this rhythm, managing the S8s, policing the 2-day Form 4 windows, tracking the 10b5-1 plans, a massive disruption inevitably occurs.
Which brings us to Chapter 6, the ultimate plot twist in the corporate life cycle, mergers and acquisitions.
An M&A event forces a violent collision of the buyers and the sellers' equity plans. Everything we just talked about gets thrown into a blender.
And this collision starts months before the deal is announced, deep in the due diligence phase.
Oh yeah, the buyer's lawyers are hunting for toxic equity history. They're looking for unregistered offerings that violated securities laws or deferred compensation plans that violate Section 409A of the tax code.
Because those violations carry massive IRS penalties that the buyer will inherit if they aren't careful.
Exactly. But assuming the seller's equity is relatively clean, the buyer faces a monumental strategic choice at the closing table regarding what to do with the seller's outstanding employee stock options and awards.
And the financial fallout from that choice alters the trajectory of both the company and the employees. Generally, the choice comes down to either assumption and conversion or a cash out, right?
That's right. Assumption or cash out.
I always think of the mechanics of this choice like a couple moving into a new apartment together. Do you keep both of your old couches, which is assumption, meaning you combine everything, but it takes up way more space and dilutes your living area?
I like that.
Or do you drag the seller's old couch to the curb and just pay cash for a brand new one, keeping the room clean but completely draining your shared savings account? That's the cash out.
That analogy captures the economic tension perfectly. If a buyer chooses assumption and conversion, they convert the seller's outstanding stock options into options to buy the new combined company's stock.
And the massive strategic advantage for the buyer there is capital preservation, right? They don't have to write a massive check to the seller's employees. They are simply trading paper for paper.
But the clutter comes in the form of share dilution. The buyer is adding millions of new potential shares to their pool, increasing the overhang, which means existing shareholders own a slightly smaller piece of the pie.
Right. And from a tax perspective, the math of conversion is terrifyingly delicate, isn't it? Especially when dealing with incentive stock options, or ISOs.
Oh, it is brutal. ISOs carry special, highly coveted tax favor status for employees. If a buyer wants to assume and convert those ISOs without accidentally destroying that tax status, they must strictly adhere to the mathematical formula in Code Section 424.
Code Section 424.
The core mandate of 424 is that the new option cannot give the employee a better economic ratio than the old option.
But wait, if you're converting an ISO from the seller's stock, which might be valued at $20, to the buyer's stock, which is valued at $100, the underlying asset is completely different. How do you keep the IRS happy when the numbers are totally misaligned?
You focus on the aggregate spread.
The spread being the difference between the fair market value of the stock and the exercise price the employee has to pay.
Exactly. The ratio of the exercise price to the fair market value and the total dollar value of the spread must be identical before and after the conversion. If the conversion math accidentally gives the employee even one extra penny of intrinsic value, the option instantly loses its ISO status. It reverts to a non-qualified stock option and triggers a devastating new tax reality for the employee.
So if the math is too complicated or the buyer just doesn't want the share dilution, they choose the other route, the cash out.
Right. They cancel all of the seller's outstanding equity awards and cut the employees a lump sum check.
Which preserves the buyer's share pool, keeping investors happy, but it severely drains cash reserves.
And for the rank-and-file employee, getting a massive check sounds incredible until they realize it triggers an immediate, fully taxable event.
That lump sum is treated as ordinary income. The employee might lose 40 to 50% of that cash to taxes immediately, rather than enjoying the deferred tax benefits of holding options.
It is a brutal balancing act for regular employees.
Mhm.
But the top executives usually have a different set of rules during an M&A event.
Of course they do. They negotiate change in control agreements that guarantee the immediate accelerated vesting of all their unvested equity the second the deal closes.
It ensures they get their massive payout, even if the new buyer fires them the next day.
But the IRS isn't going to let a sudden windfall like that slide through without taking a cut, right? There has to be a penalty for golden parachutes that get out of hand.
There is, and it is known as Code Section 280G. Section 280G exists specifically to penalize excessive severance packages during corporate buyouts.
How does it work?
Well, if an executive is terminated during a change in control and the value of their accelerated equity and cash severance crosses a very specific mathematical threshold, it is legally classified as a parachute payment.
Okay, let's test the math on that for our final exam scenario. Knowledge check number 3. Listener, if an executive receives a massive payout during an acquisition, what specific multiplier threshold triggers the Section 280G penalty, and what happens to the executive when they cross that line?
So the threshold is tripped if the aggregate present value of the payment is equal to or greater than 3 times the executive's base amount.
And the base amount is essentially their average annual compensation over the preceding 5 years, right?
Exactly. So if their average historical pay was $200,000 and their accelerated M&A payout is $600,000, they just hit the 3 times multiplier and triggered the trap.
And the penalties are a double-edged sword. The employer permanently loses the corporate tax deduction for that excess payment.
But worse, the executive is slammed with a 20% excise tax under Code Section 4999.
Section 49999, a flat 20% penalty on top of their highest marginal ordinary income tax rate. An executive can end up keeping less than 30 cents on the dollar of their golden parachute.
Which is exactly why armies of corporate lawyers spend months negotiating deal structures just to keep those executive payouts a few dollars under that 3 times threshold.
It's all a game of inches. Well, that brings us to the end of the life cycle. You have navigated the gauntlet. We traced the massive restructuring and SEC cheap stock audits of the pre-IPO phase.
We survived the brutal 2-day reporting windows and 10b5-1 insider training defenses of public life.
And we just balanced the delicate tax math of assuming versus cashing out equity during a merger. You have the mechanics, you know the why behind the rules, and you are ready for this exam.
But, before you close your notes, step back and look at the aggregate weight of everything we just discussed.
It's staggering.
The sheer volume of compliance required to offer equity, the Section 409A deferred compensation traps, the Dodd-Frank clawbacks, the terrifying 20% excise tax of Section 4999, and the relentless 2-day Form 4 reporting windows.
It really makes you question the fundamental premise of modern business. We're always taught that going public is the ultimate finish line, but with the staggering administrative burden, the constant threat of SEC audits, and the total loss of privacy for executives, is the traditional IPO dream actually becoming a deterrent?
It's a great question.
You have to wonder if the smartest strategy for a modern, well-capitalized company is simply to stay private for as long as humanly possible, just to avoid the massive, expensive machinery of public equity administration.
It completely reframes the goal of corporate growth, honestly. Success might not be ringing the bell. Success might be avoiding the bell entirely.
Something to think about as you review your notes. Good luck on the exam. You have the knowledge to absolutely conquer it.
Best of luck to you. Keep these mechanisms in mind, and you will do exceptionally well.